Long-term investing is one of the most powerful wealth-building strategies available to beginners, yet most people ignore it not because it is difficult, but because it is simple. And simplicity is often overlooked in a world where people expect complexity to equal value. Many beginners assume investing requires perfect timing, expert-level knowledge, or advanced strategies, when in reality, long-term investing is built on something far more basic and far more powerful: patience. The core idea is straightforward: buy assets, hold them, and stay consistent over time. But behind this simplicity lies a system that works silently in the background, shaped by time, discipline, and compounding. At first, progress feels extremely slow and almost unnoticeable. But over years, that slow growth transforms into significant wealth-building momentum that becomes increasingly powerful. The first major principle is time, because time is the most important factor in wealth creation. Investments do not grow instantly. They grow gradually as compounding works in the background. In the beginning, the results often feel insignificant. But over long periods, time multiplies even small gains into meaningful outcomes that cannot be achieved quickly. The second principle is consistency, because investing once or occasionally is not enough to build real financial growth. Regular contributions, even if they are small, create a steady rhythm that allows wealth to accumulate over time. This consistency builds momentum, and momentum is what turns simple investing behavior into long-term financial progress. The third principle is patience, and this is where most beginners fail. It's not because investing itself is wrong, but because emotions take control. Many people panic during market declines, sell early, or stop investing completely when conditions feel uncertain. However, long-term investors understand that market cycles are normal. Short-term volatility is part of the process, not a signal to quit. The fourth principle is simplicity, because successful investing does not require complicated strategies or constant decision-making. Simple investment options like index funds, ETFs, and blue-chip stocks often provide strong long-term exposure without unnecessary complexity. This simplicity reduces stress and allows investors to stay consistent without emotional pressure or overthinking. The fifth principle is discipline, which is the ability to stay consistent even when emotions suggest otherwise. Long-term investing is less about action and more about control, specifically controlling reactions to market noise, trends, and short-term fluctuations. Investors who avoid emotional decisions tend to perform better because they stick to systems rather than reacting impulsively. Another key concept is compounding, where money earns returns, and those returns begin earning additional returns over time. This creates exponential growth, but only when enough time and consistency are present. Compounding does not reward speed, and it rewards patience and long-term commitment without interruption. Many beginners underestimate the importance of time because they expect fast financial results. But investing is not designed as a quick income system. Instead, it is a growth system, where small actions repeated over years gradually create large outcomes. The longer the time horizon, the more powerful the results become. Risk tolerance is also an important part of investing, because markets naturally fluctuate in value over time. Volatility is not a sign of failure or danger, it's simply normal movement within financial systems. Understanding this helps investors stay calm during uncertainty, instead of making emotional decisions that damage long-term returns. Emotional control is one of the most critical factors in investing success, because fear and greed often drive poor financial decisions. Fear causes investors to exit too early during downturns, while greed leads to excessive trading or risky behavior. Both emotions reduce long-term performance, while disciplined investors remain steady and focused on their strategy. Another essential principle is starting early, because time in the market is far more important than trying to time the market perfectly. Even small investments made early can grow significantly over time due to compounding effects. Delaying investment often has a larger negative impact than starting with a small amount. 3 key insights emerge clearly from long-term investing. First, it is simple, not complicated. Second, time and consistency are the real drivers of wealth creation. Third, emotional control determines long-term success more than intelligence or strategy. In the end, the investors who succeed are not necessarily the smartest, but the most patient, because patience allows compounding to do its work, and compounding is what ultimately builds lasting wealth.